Okay, let's unpack this. We're diving into a pretty candid 2022 annual letter from a portfolio manager over at Capital Alphabet. They actually called the year a reckoning.
Yeah, it's quite a description. This whole deep dive is really about how they navigated those, well, dramatic market shifts
Mm.
and how that actually created some unique opportunities. We'll also get into their maybe surprising definition of superior performance, especially in a year where, many people really struggled.
Right. And what really struck me from the start was how the manager framed it. There's this parallel to Tolstoy.
Oh, yeah, the Tolstoy quote. Happy investors are all alike. Every unhappy investor is unhappy in their own way.
Hmm.
It really sets the stage, doesn't it? Captures that feeling of widespread distress, but also these very specific individual paths, maybe even towards success.
Definitely. And that transformation, it was so stark. Think about this. At the beginning of 2022, if you wanted, say, a predictable $100,000 return, you needed something like $20 million invested in high-grade bonds because yields were, what, 0.5%?
Yeah.
But then, fast forward, less than 6 months later, the Fed hikes rates aggressively, and suddenly you only needed $2 million to get that exact same $100K return at 5%.
It's a 90% drop in the capital needed.
Yeah.
For the same income, it's huge.
Huge.
And this rapid shift in, discount rates, which is
Yeah.
basically how we value future money today,
Yeah.
it's not just some finance jargon. It's the core mechanism. Rising rates just immediately hit the value of future company earnings.
You're right.
And the manager's point is that this forced a brutal rethink about what true intrinsic value really means. Even good companies could suddenly look way overvalued. They basically say, look, either the market was undervalued before or, the carnage is not nearly done.
Hmm. So given that shock, how did this manager even start spotting opportunities when, others were heading for the exits? They described 2022 as a manic depressive market, which sounds dramatic, but maybe it's insightful.
I think it is. It suggests that for a, let's say, disciplined investor, that volatility isn't just noise or panic. It's actually a signal. It flags potential entry points. Their main focus wasn't trying to time the market perfectly, but just relentlessly finding those substantially undervalued securities.
That focus on intrinsic value, the actual economic debts of a business, seems key.
Absolutely core to their philosophy. And it sounds a bit counterintuitive, maybe, but their goal for long-term superior performance isn't about winning every single year. It's often about achieving better than average performance when markets are flat or, importantly, declining. They might even underperform a bit in roaring bull markets.
So let me get this straight. If the overall market tanks, say, 30%, but their fund only drops 15%.
That's considered much superior performance in their book.
Yes, yeah. And in 2022, Capital Alphabet, starting from June, mind you, they posted a gain of almost 30%, 29.91% specifically. Meanwhile, the S&P 500 lost 6.69% in that same time frame. That's a massive difference.
It really is.
Yeah.
But what's fascinating is what the manager says about it.
Mm-hmm.
They directly admit that gain was distinctly abnormal. And crucially, not because they timed the market. They state pretty clearly, we never tried to guess market direction.
So it wasn't luck or forecasting.
No, it reinforces their belief that the real gains come from identifying quality businesses that are just trading way below what they're intrinsically worth, not from predicting, the next week's market moves.
That conviction must have shaped their actual investments then. I remember seeing China mentioned, like Tencent and Alibaba.
Yeah, that was a key example in 2022. Despite all the negative headlines and headwinds, they saw it as a compelling opportunity.
Yeah.
They viewed those companies essentially as a duopoly with strong competitive advantages, those moots everyone talks about. Plus, there was that interesting Naspers arbitrage play.
Ah, the arbitrage. How did that work again?
Well, basically, Naspers held a lot of Tencent stock, but Naspers itself was trading at like a 30% discount compared to the value of just its Tencent holdings. So they bought Naspers to get Tencent cheaper, essentially profiting from that price gap. Naspers turned out to be their rockstar investment that year.
Rockstar. Wow.
Yeah, single-handedly contributed almost 33% to the portfolio's gain. They also had positions in some Canadian oil and gas firms like Baytex and Gear. These were companies cleaning up their balance sheets, generating strong cash flow, paying dividends, though they do acknowledge commodities are always a bit speculative.
Okay, so pulling this all together, what does this mean for you, the listener? This deep dive really highlights a philosophy aiming for long-term superior performance, but defining that often as doing better than average when markets are tough. Like we said, down 15% can be way better than down 30%.
Exactly. And what's really striking, I think, is that admission about the 2022 gain, that huge 29.91% against the S&P's loss being distinctly abnormal and not market timing. It really makes you think. If patient investing means, as they say, the ride will never be smooth, and future advantages might be much smaller on average, well, it raises a big question, doesn't it? How do you define success and patience in your own financial picture?